My name is Michael Duke, and this is the show where I talk about stocks that are interesting. So if you find that interesting, then please consider liking the video and subscribing to the channel so you see more of it. Earlier today, I posted a video about my thoughts on the tariffs. And in that video, I kind of walked through some of the sectors in the United States stock market that were doing well, and along with commodities and bonds and whatnot, kind of just walking through the general market reaction to the tariffs. And if you are interested in that, then be sure to check that out on my channel. But now I'm going to be doing, as I often do, a dive into a company. Now, this is one that we've covered before on the channel, and I want to revisit it because I do think that the outlook has changed for this particular company. So, in November, I made a video about Otis Worldwide, ticker OTIS, and I also wrote an article here that I posted to Seeking Alpha. If you don't follow me on Seeking Alpha, then be sure to do so. I'll have the link in the description and in the pinned comment. If you don't have the premium or pro subscription, you can't read all of the analysis that I post on there, but I also have a link that I'll post as well that allows you to get a discount and a free trial on those subscriptions. So be sure to check that out as well if you're interested in reading my analysis. It's a little more coherent than me just sitting here and talking. But what I wanted to discuss is I want to revisit this analysis here. Okay, so again, this is November 27th, 2024. We see that both in the video I made and in the publication that I made here, I rated the company a hold. Now, of course, we see our returns here. The stock has significantly outperformed the S&P 500 in that time by about 12 points. While I'm not surprised by that, I certainly I certainly was not overweighting my portfolio towards the name. I continue to hold the shares, have not sold a share of the company. And the last few months have really changed my view. And today being the nail in the coffin, I wanted to rediscuss the stock. So, this video is going to be less about talking about what the company does. There's going to be a presumption that you understand that already. If you don't, be sure to check out my other video, my initial video about the stock. I describe what it is, and how they make money, so on and so forth, and give my initial thoughts. So the idea here behind the hold rating was multiple. There are multiple prongs to that thesis, which I think now require a reevaluation. The first being significant exposure to foreign markets in the service business pose currency risks and questions about long-term growth rates. Okay, that's noteworthy. And then we also talk about its current valuation isn't compelling for outperformance, which I still would say is true. So here's a couple of things to consider. The two primary risks that I highlighted are significant exposure to the Chinese market and currency fluctuations. China representing roughly 60% of global new elevator demand, and the recent slowdown in Chinese real estate. You have much different news dominating economic news cycles, with China being really the main market for growth in the services that Otis offers. And here I talked about currency risk. We discussed kind of how it's had weak momentum. Again, at the time of this writing, the price was 102.52. I'm not going to dive into this too much, but I'm going to try to keep this organize my thoughts simply. Today was the steepest sell-off I've seen in a while in stocks. We had the S&P 500 down almost 5 points, and really the SPY down almost 5 points. The QQQ 5.5. All sectors in a sell-off, notably energy down almost 8%, financials down 5, discretionary down 6. In fact, technology 6.71. In fact, only staples had a good day today, which is great for us because we're overweight staples. But a couple other things, all markets, global markets sold off with the exception of Brazil in our 7 country panel here. The US market fared way worse than most other markets, I think for obvious reasons. Bonds rallied today, gold and silver sold off. Most commodities did. Here's what I wanted to highlight. The dollar is getting weaker. In fact, you see here the dollar down 1.5 points today, 3.2 points over the last month, 3.3 points year to date. You see versus the pound, euro, and Japanese yen, the dollar is depreciating. We highlighted how with significant international exposure that the company has, that was a risk. Well, what I think is fair to say now is that risk might be a good risk for the stock. So a couple of things. And the S&P sold off nearly 5 points today. Meanwhile, Otis Worldwide was green today. Okay, that's telling. Almost all consumer staples were green today. Costco was green. Philip Morris, Pepsi, Coca-Cola, Hershey, all the ones that we talk about were green. CME Group, stock that we covered within the last few months, was green today. Okay, so why was Otis green today? Well, I think let's back up a little bit. Let's take a look at how Otis has done year to date. So a couple things going on. What is happening in US versus China markets? You had last year, really for the extent of last year, you had a lot of weakness in Chinese markets. The Chinese stock market was way down. In fact, what is the Chinese? The Shanghai index? Okay, the Shanghai index. So what do you see here? Throughout the first 3 quarters of 2024, let's go back a little further. Chinese stocks were, in somewhat of a bear market. Maybe not a bear, but, relatively flat for the last several years and then sold off before rallying, but have been relatively flat. However, they have significantly outperformed the S&P, and of course, one of the reasons for that being the DeepSeek controversy. And if you're not aware of what the DeepSeek controversy is, or the DeepSeek news, it's of course DeepSeek, the open source Chinese AI model created by a hedge fund. It was at the time of release shown to outperform our American models like the OpenAI led models, that type of thing. It outperformed. It was significantly lower cost. That caused a lot of fear among tech stocks, kind of led to some volatility there. And then now you've got tariffs impacting our market. So the Chinese equities have performed much better than our equities. Now, do I expect that to continue into the future? It's not exactly clear. But one thing is clear to me, and that's that Otis, what's going on? So I think what I'm trying to say is that Chinese exposure was penalizing companies in the marketplace. And then this year, it really the opposite has been the case, it does seem, because there's been this narrative of the Chinese century taking place. So while all of the same risks remain, whether that be geopolitical risk, China is our main adversary in this trade war. So owning a company that does business in China, there's some risk with that if there were ever to be substantial conflict between the two nations. So that's still true. However, what we're seeing is that the Chinese equities rallied while our tech stocks really took a back seat. And what that has done is stocks like Otis, which are somewhat defensive, but also have these compelling potential growth elements to them, have outperformed year to date. So we see a significant divergence start to occur here between a company like Otis Elevator and the S&P 500. If we just visually scan through for the last 3 years and we look at any meaningful peak or valley, there really is no time that I can see, with the exception of right here, where the direction of movement of the two prices diverge in any meaningful way. But here, that does happen. I cannot stress enough how highly correlated these two, the index and this asset, have been up until right here, where our stock starts to diverge. That is really interesting because what has been happening is that Otis has not really traded defensively. It's traded with strong positive correlation to the index. But what we're seeing now is a divergence away from that. And so immediately I'm paying attention to that and I'm locked in. And then when we see on a day like today, when the stock trades with a lot of strength, what we're seeing is that this stock may be demonstrating a trading behavior that just became a million times more interesting. Why would shares of Otis Worldwide not sell off steeply on a day like today? Well, that's because in each country that is doing business, it doesn't sell elevator parts. It might, as part of its service portfolio. But the idea is more the service portfolio is an asset light business with strong, recurring, sticky revenues. So a services based business is not something that you tariff because the business operation is located in that nation, right? The Chinese operation is in China. You're not importing or exporting anything to perform that service. The point still remains. It should be very simple of a service is not a good, and therefore services are industrial services that are recession resistant, as this is, tended to do very well today. Again, I think it would be helpful if I highlighted another business. Waste management, of course, very simple to understand. It's a service business, right? Geographically, it doesn't have the diversification of Otis or public services also. So you get the idea. An industrial service is insulated from this tariff risk somewhat. Okay. So I think we should go over the earnings call, which again, this was all the way back in January. So here in about 3 weeks, 3.5 weeks, we will have another earnings call. Okay. And perhaps it would be smart if I waited to do this video until after that time, but ain't nobody got time for that. So we're going to get into it. So this earnings call is notable because they detail out the results of the fiscal year. Okay. So again, we know the services business is the most important part. Services grew organically by 6.8%. You had operating profit margin expansion of 50 bips, 8.2% adjusted earnings per share, 12.1% modernization orders growth. Modernization meaning fixing up existing elevators, not new construction, but modernizing existing systems. Okay, so you see here, new equipment continues to backslide, but modernization very strong. And then portfolio units in service up 4.2%. This is the engine that makes everything crank, right? In the quarter, earnings per share versus the prior quarter up 6 cents, 4 cents from operations and 2 cents from buybacks. So one thing that we talked about in the prior video was that there's a high level of financial engineering with this stock, that they buy back a significant amount of their shares, which is accreting a lot of value to shareholders. While, of course, that's beneficial to us as shareholders, it is worth noting that the underlying business is not growing as quickly as the earnings per share. Okay. Just something to note. Again, this is in the quarter, year over year comparison, segment operating profits. Not only is new equipment operating profit down 28%, but profit margins also contracted 140 basis points. Those are really ghastly numbers. But we do see less than 100 million of operating profit from new equipment, almost 10 times that level of operating profit from service. And that increased 9.8%. So again, the services business is what is the cash cow. The new equipment business is kind of a loss leader almost. It is profitable, but you notice here just how much of the profit is being driven by services. For the fiscal year, you see that there were some currency headwinds. Now, year to date, the dollar is depreciating. So I would expect, again, if that continues throughout the year, which there is a strong likelihood that it will, given what's going on right now. I'm not going to discuss why. Maybe that's a topic for a different video. But the idea being that a strong dollar creates a headwind for earnings per share for this company, the opposite being the other case. So when the dollar is weakening, stocks like Otis should get bid up, and that's what's happening. We see industry installed base unit growth. This is the outlook of the industry. So new equipment down globally, but installed base unit up. Okay, this is kind of a weird slide, but we see here they're guiding to 1.6 billion of free cash flow, and they're going to buy back $800 million of stock, which at today's market cap represents about 2% of the market cap. It doesn't seem like a lot. It doesn't seem like a lot, but that really adds up over the years. We know this. Here's another thing. As of January, what the company is guiding towards is they're guiding to adjusted earnings per share going from 383 to 4 to 410. So that's 5 to 7%. No, sorry, 4 to 7%. But look at this. They're still guiding towards currency risk being a headwind. And I'm not so sure that that's going to be the case. I actually think that it could be a tailwind. So imagine if you see this be flat or go the other way, you could double guidance here. If that happens, then the stock might pop. They're going to buy back a little bit less shares, generating about the same amount of free cash flow. There's a slide somewhere that talks about their currency mix. Here's an idea of the geographic mix. New equipment, service, maintenance units. Okay. So they actually have more units ex-US than otherwise. Here we go, right here. Currency exposure. So you see that only 30% of sales are in dollars, right? When the dollar is really strong, it is a headwind to this stock. So we have a really strong underlying business, this services business that's asset light, generating a ton of free cash flow. So when we see a weak dollar, in theory, a weakening dollar could cause drastic outperformance of earnings per share. But that's the idea. The reason there's really nothing about the underlying business performance that appears to be changing to me. And I'm cautiously optimistic. I'm gonna revisit this when they release their earnings report, which should be here in about 3 weeks. We're gonna take a look. You see here they're expected to come in pretty flat all across the board, which the expected earnings per share band here will equate to roughly 3.25% growth year over year. Not exactly earth shattering numbers, okay? But a couple things to look out for in this upcoming earnings report are a dividend increase. They've increased the dividend by 5 cents a share for 1, 2, 3 straight years. I don't see any reason why they won't. I expect a smaller increase than this, but we'll see. I mean, their earnings per share aren't growing by 16%, but I guess if they're going to continue to juice the payout ratio, then they'll continue to do that. But either way, I expect a dividend increase. the degree of that dividend increase is likely to catalyze the stock one way or another. I want to take a look at their earnings. However, barring anything earth shattering about that, I don't really see any reasons why the underlying business performance will change with tariffs. Because again, what is their exposure? The new equipment piece, they're sourcing that new equipment at close to the point of sale in theory, right? So I don't, out of all of the businesses that I cover, this one has to be in that upper quartile of, you know, low to non-existent tariff exposure. Because again, services, you can't tariff services like that. You're not importing that. We might start to see that type of retaliation, but again, the Otis China enterprise is there's a entity in China that's a subsidiary of Otis that's operating that. Like, what are they importing? So again, we're talking about very strong insulation from tariff risk, recession resistant cash flows, and then you have these kind of two bonuses on top, which are that the market finally seems to be appreciating the defensive qualities of the stock more than it used to. And then we also have these currency tailwinds. So, for that reason alone, my outlook is increased on this. Before I gave kind of a very neutral review of it. And I think I still have all of the same, like, meh concerns about it. I do have the stock in the portfolio, but my outlook, I'm more bullish on it now than prior because of the events of the last several months. Most notably, the performance, the relative strength that is trading on. That's important. I pay I weight that significantly because the market is smarter than I am, and smarter than you. And so we have that plus currency. So for that reason, I'm, yeah, more enthusiastic about Otis now than I was before. However, I am going to be paying attention to the upcoming earnings report and more than willing to change my opinion based on that. But I don't expect any surprises. So, yeah, that's the idea behind this, is that I think that the backdrop, macro wise, is beneficial for Otis. The only thing that may be worse than before is just tension with China, and how that might impact American entities doing business in China. But there has to be a very, very, very severe conflict for that to become a problem. So I'm upgrading Otis from a hold to a buy. Now, one thing to consider, though, again, is this. Okay, I think when we wrote about this before, we had failed to break out. Stock was on the way back down. We had failed to break out. We are still in that regime. Okay, we're still in the regime whereby we haven't been able to get to new all-time highs. Okay, I think that's probably the biggest demerit on the bull case right now. Is just technically speaking, although we did demonstrate some relative strength today, we still haven't broken above. So I'm developing a more bullish outlook on the stock. However, there's a few things worth watching before, like, going full tilt overweight level of bullishness on it. But I think the earnings report could catalyze, and we'll just have to see. Because again, when did our quarter end? Was this December? The quarter ending in December? It's not clear by looking at this information, but it is possible that some of those currency tailwinds, what I believe are tailwinds, could show themselves in this upcoming earnings. So I'm going to be watching very anxiously on the earnings report to see how that turns out. So anyways, that'll conclude our video for today. But hopefully you found this interesting, and let me know how I'm doing. Feel free to engage, comment, and interact, and I will be sure to get back to you. hopefully you've had as much fun watching as I have creating, and we will see you next time. All right, have a good rest of your day and stay safe out in these markets, these crazy times out here. Make sure you position accordingly and manage risk. All right, thank you, and I will talk to you soon.